विशा जी चालू करें 5 बजे। The chairman of WRF ICI, CA Ankit Rathi, under whose dynamic leadership WRC has been doing wonderful activities across the region. Very hardworking, sincere, ever smiling secretary of WRC, CA Gautam Lath. The coordinator of the session and series, my dear friend Chandan Lahoti. Today's speaker and expert faculty of the topic, CA Shashi ji. The coordinator of the session, CA Shaivi, and all participants. Good afternoon, everyone, and welcome to the Tuesday series of AS Ind AS. Before we start upon, I request the WRC staff Misha ji to play ICM motto.
येष सुप्तेषु जागृति येष सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता.
Friends, with the objective to create awareness on accounting standard, Ind AS and auditing practice, the WRF ICI has taken this year initiative to have a series of sessions on every Tuesday. So, and this has been happening since last more than 2 months, and it's going to be there throughout the year. So please mark your calendar that Tuesday 5 p.m. is to register only for Ind AS and AS and audit series. Today we are having a 30-minute faculty for a topic which is a critical, important Ind AS 116. As you are aware that 116 list standard has been there since last more than 2 years, but there are a few critical challenges which has been faced. The current year is about modification of lease contract. At the time when we implement Ind AS 116, the top most priority is to how to determine incremental borrowing rate for the purpose of a leases rate. Once it has been done, we have obviously challenged with respect to identification of lease contract listing, then whether shall we opt for exemption or not. But now I think there's also another very, very important thing of contract modification. And this is a really right time for all of us to understand and sharpen our knowledge. We are having with us a very eminent faculty has an experience of as an auditor, as an Ind AS expert in implementation of this topic. So Shashi ji, thank you so much for giving consent and coming here to address participants of WRC ICI. Not taking much further, not taking much time. We do have a pleasure to have the chairman and secretary of WRC ICI with us. I request the chairman of WRC, CA Ankit Rathi ji, to kindly give his words of wisdom.
Thank you so much, Chintan bhai. Very good afternoon. It's absolute pleasure to be here with you all in this virtual room. At the outset, let me first recognize the presence of Honorable Secretary, West India Regional Council, Gautam bhai, my regional council colleague and very senior council member, Chintan bhai, is also the chairman of Ind AS and Audit Committee of West India Regional Council of the ICI. Our today learned, acclaimed and prolific faculty, Shashi sir. Sir, thank you so much. Despite of your so much busy schedule, you accept our invitation and being agreed to share your valuable knowledge with the participants. The man behind this entire series, who is coordinating with the each and every speaker, Chandanji Lahoti. Chandan bhai, thank you so much for taking so much effort for the fraternity and our West India Regional Council. Our today coordinator, Selvi. Dear friends, let me tell you and let me update you, the expectation of our stakeholder and regulator is very, very high from each one of us. So that's why we thought, why we not create a series of the sessions on Ind AS, auditing standard and the accounting standard, so we can sharpen the knowledge of our participants, because we need to update ourselves so we can put our 100% at the time of the doing the function of auditing and all that. So that's why we start this series on every Tuesday, as rightly point out by Chintan bhai. Please mark your calendar, on every Tuesday we will be here on 5 to 7. We'll update on each and every accounting and auditing standard, and our today topic about the lease, which is also we can say very important and need of the heart the topic. And for this we have a very learned Shashi sir. With this, I again thank you so much and wish you happy learning. I request Gautam bhai for his address.
Thank you, Chairman sir. Let me first thank and congratulate Chandan bhai for this wonderful show. Chandan bhai, we know that how we started technicals on Tuesday, and we can see it live since 2 months it is running. And obviously a major contribution from Chintan bhai Patel, who has done day in day out working hard. They are selecting the faculties, discussing topics and everything. Thank you so much for doing so many things for the fraternity. Uh, Only one request I would like to make. See, friends, uh, in couple of years, we have seen, as our chairman has said, that the expectations of stakeholders are very high, and we see sometimes certain news coming in social media or news media, and we tend to forward it, which is the one CA has done this, or some NAFRA order has come, there is some CA pled guilty or something, and we tend to forward it. So we thought, as a chairman, the first statement was that, Gautam, we do a lot of seminars, we'll do the webinars, we'll do everything, but what should we do to increase the reputation of this institute or this profession? Because whatever we are today, this is because of these two letters. So I still remember, when Ankit ji became chairman, the first statement was that, what should we do to have this type of reputation and the legacy which our forefathers have created of fruits, obviously the fruits of which we are enjoying today as a chartered accountant. So what we should do? So we thought, let us change the perception of stakeholders. So friends, let me tell you what we have, started doing at WIRC, and then one request I have to make. So we thought, what we can offer to the stakeholders or to the regulator. We thought, the ICI is established as a knowledge partner, so we can definitely share our knowledge and resources with the stakeholders and the regulator. And let me tell you with proud that today, when I stand before you, we have trained more than 1,500 bureaucrats or officers. We have trained GST officers, we have trained SFI officers, we have trained EOW, we have trained RBI, we have trained SEBI. You name any regulator, and as a WIRC of ICI, we are giving them training on Excel, on different areas, on accounting, on financial statement, and different couple of things on taxation matter, on structuring everything. So this is what we are doing at WIRC of ICI to change the perception and to bring ICI as a knowledge partner or as a true leader in the country and changing the perception of stakeholders or the regulator. One small request I have to make all of the participants, that whenever you receive any negative message, let us refrain to forward it in the social media. See, I am not asking you to defend any CA कि किसी ने कुछ गलत किया होगा उसको अपने को बचाना है. The idea is that whenever we forward it it ultimately bring disrepute to our own profession, to you and to me together, right? We have many grievances, we have alternate remedy, everything is available, that if you have any complaint against a chartered accountant, we can approach DC, we can approach, many things are there. So let us not put negative things about profession in social media. That's the only request I wanted to make. Thank you so much. Over to you, Chintan bhai.
Thank you so much, Chairman sir, for setting a tone and setting expectations of the participants and faculty with respect to taking ourselves little ahead and setting the tone for the purpose of auditing profession. And thank you so much, Secretary Gautam Bhai, for laying the foundation and making sure that we really live up to the expectation of ICI brand. And to maintain and increase the brand is in the hand of everyone, not one person or a WRC. Each one of us should come together and to form a brand. It's really wonderful for all of us to take it ahead. And not take much time further, I request the Chandan Lahoti, I will say the series coordinator, to introduce the faculty in this session.
Thank you, Chintan bhai. Thank you, Gautam bhai. Thank you, Ankit bhai. Uh, Really, I feel privileged to introduce Shashi today because in my early days of my career, I have worked under him. I've gained a lot of knowledge, and today also, formally, informally, whenever I have any queries, I reach out to him. So that's the figure for me. Shashi is there, and I'm introducing him today. So Shashi is a qualified chartered accountant, experienced more than 20 years. Today, he is an audit partner with Walker Chandok and Company, Pune. He has an experience in auditing Ind AS, IFRS, a lot of promoter-driven companies, international, multinational companies. He is auditor himself as a signing partner for a lot of listed companies. Shashi has led a lot of complex, led a lot of IPOs, gap conversions, fundraising, due diligence, businesses. Shashi has also advised on a lot of improving finance function, process control in a lot of large companies. He has, I would say, worked in multiple cities, not limited to Pune, Mumbai, Bangalore, and experience in statutory audit, financial reporting, etc. And today we are privileged to have him uh, on a topic which he has deep dive and worked on large listed companies where this particular topic, IFRS 16, Ind AS 16, as the case may be, he has dealt it practically in depth with most of the complexity for the topic for his clients as a partner. So happy to have him here and request and hand over to Shashi to take up the next charge.
Thank you, Chandan bhai. I was just wish to take one more minutes about the update of our 38th regional conference. Friends, let me share you or update you. This first time we have already launched the long back our 30th regional conference. We are hosting at Geo Convention Center on 23rd and 24th August. In this 2-day regional conference, we are trying to cover the topic like uh, the role of technology and AI in auditing and accounting, how technology can change the way of doing auditing and accounting, the role of sustainability futures, the offshore opportunity for the chartered accountant, then roles of virtual CFO, and many more. So I wish and I request each one of you, please do register for our 30th regional conference, which we are hosting on 23rd and 24th August, Geo Convention Center, BKC, Mumbai. Thank you so much. Shashi sir, over to you.
Thank you. Thank you so much. Thank you very much. Honorable members and chairman.
Shashi,
Your time
your voice is low, Shashi.
Am I audible now?
Now, yes.
Okay. So I'll just share my screen and if you can please let me know when my screen is visible.
Done. Visible.
Okay. Good evening, everyone. To start with, this standard came in a couple of years back. This is it's not a recent standard in that sense, but there are a lot of practical implementation challenges, and we'll probably over next 1.5 hours we'll probably deal with some of the aspects of the standard. It's a very long standard, very vast standard. So what I've tried doing is try covering as many aspects as possible. There are certain aspects which I've deliberately left out of the scope of the standard. For example, the lesser accounting and presentation disclosure is something which I've deliberately excluded because otherwise it will become a too longer period and maybe there may not be too many practical implementation issues in some of those areas. That's it. So just to start with the core concept of the standard itself. So if you see the way in which the lease accounting was previously recognized was essentially it was divided between a finance lease and operating lease. So the operating lease accounting was essentially an off-balance sheet reporting. It was on P&L. So the lease rent was recognized on a straight line basis in P&L, both under Indian GAAP and erstwhile Ind AS standards as well. The very objective of bringing in this standard was to bring in a comparability among different kind of leasing arrangements because what the standard setters felt that if a particular company is having a particular term for leasing of a particular asset, depending on how the commercials are structured, how terms conditions are structured, it may become on balance sheet, it may become off balance sheet, and the way in which the accounting charge gets recognized in P&L also will vary significantly. That was the whole objective of introducing this standard. So, in effect, what this standard does is it introduces a concept very similar to what was being done under the finance lease accounting, very similar to that. So, it becomes a balance sheet oriented reporting. On in the balance sheet, the lease asset is recognized as a right of use asset equivalent to an intangible asset, and the obligation to make payments is recognized as a liability. The lease expense, which was previously recognized in P&L, now gets recognized in two forms. One in form of a depreciation, which is amortization of the ROU asset, and the second one is the interest component on the financial liability. What effectively this does is it creates a little bit more front-loaded charge, because the ROU asset is effectively getting straight-lined over the lease term, whereas the interest in the initial period will be significantly higher, and therefore the charge to P&L will be higher as compared to the previous accounting of operating leases. And also in terms of P&L, the both the depreciation and interest effectively move the expense line item below the EBITDA level. So previously the lease expense would be recognized as part of an operating expense. Now that is moved below EBITDA level. So the net effect that actually it will create could be a higher charge in P&L, and my EBITDA, the EBITDA of a company will be reported, will be substantially higher as compared to it was there before. So what exactly is covered in the standard? So what I've tried doing is I've basically analyzed the definition of lease under the standard, and then looked at each aspect of that definition in detail, with some of the practical examples being covered. So the standard, the definition of lease has not undergone a change significantly. So what was there under IFRIC 4 under IFRS plus the equivalent lease standard has now been brought in as part of a definition. And what the standard now requires that at the inception of a lease, any arrangement, any contractual arrangement need to be evaluated whether it contains a lease or not. The definition of lease actually says that a contract is or contains a lease if the contract conveys a right to control an asset, to control the use of an identified asset for a specified period of time in exchange for a consideration. So there are essentially these four aspects on which the entire presentation for today is actually based. Let us cover each of those aspects one by one. What I'll do is to start with, I'll actually start with the second aspect first, and then I'll probably come back on the first aspect on right to control the asset. So let us focus on the identified asset as a first criteria. So the standard basically says that an asset, so any arrangement, so it need not be in legal form that an arrangement has to be a lease. It may be any type of contractual arrangement may contain in substance lease. The one of the key criteria for that being recognized is it has to be an identified asset. So pure play service arrangements are excluded from the scope of the standard. Uh, the standard deals with identified assets. So if we again go back to this definition, a right to control an identified asset. So what is an identified asset? The asset need to be either specified in the contract, either explicitly or implicitly. The asset should have either a physical distinct form, or the customer has the right to receive substantially all capacity of the asset. Uh, 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 if these two criteria are met, then if the customer should not be, if the supplier has a substitution right, then in that case, it is not considered as a lease. If there is no substitution right, then in that case, it is considered as an identified asset. We'll actually elaborate a little bit more in detail for each of these aspects. So what exactly is an explicit or implicit asset? What exactly is meant by a customer having a right to receive substantially all of the capacities of the asset? If supplier has substantive rights or not, we'll probably try and understand this by means of an example. Each of them by means of an example. So let's look at the first example. So what exactly is meant by asset being implicitly specified? So let's see this example. A customer enters into a 5-year contract with a supplier for use of a belt conveyor specifically designed for the customer, for that same customer. The belt conveyor is designed to move materials used in the customer's production process and is not suitable for any other customers. The belt conveyor is not explicitly specified in the contract, but the supplier owns only one belt conveyor that is suitable for a customer's use. If the belt conveyor does not operate properly, the contract requires the supplier to repair and replace the belt conveyor. The supplier cannot substitute the belt conveyor. Now, in this example, the belt conveyor, because of the facts given, will become an identified asset. So while the contract could be for movement of materials within the premises, and the contract may not have explicitly specified the belt conveyor as part of the contract, but in that case, so for example, a serial number of the belt conveyor is not specified, but it is implicitly specified because the supplier has to use this specific asset to fulfill the contract, which is for, say, for example, movement of materials within the factory. And therefore, that will be considered as an asset implicitly specified within the contract. Let's look at a second example where asset is explicitly specified. So let's think about an e-commerce company called as Flipzone. So Flipzone is an online retailer. It enters into an arrangement with a warehouse facility in Pune with Z-Cart Logistics for the right to store ready-made garments in a specified storage warehouse. So it's a single warehouse within which a contract has been entered uh, to specify to store the ready-made garments. The warehouse has 20 racks serially numbered, and the racks 1 to 11 are contractually allocated to Flipzone with an exclusive right to use. Z-Cart Logistics does not have substitution rights. The storage space which is allocated to Flipzone represents 55% of the storage capacity of Z-Cart Logistics within the same warehouse. Whether the storage space, the capacity portion used by Flipzone, will it meet the definition of an identified asset? So while only 55% storage is used by Flipzone, but the rooms are specifically, the, the racks are specifically specified in the contract. And these are physically distinct. The Z card does not have any substitution right. And therefore, although the capacity used is not substantial, but because a capacity portion has been very explicitly specified within the contract, therefore it will be considered as an identified asset. Can I also request participants to post their questions as and when they have one? And in case if I'm going too fast or too slow, please let me know that also in the comments. Thank you. Let's move on to the third example, where so if I just go back here and look at whether the asset is specified explicitly or implicitly. So we saw the examples of that. If the asset is physically distinct or there is a capacity which has been allocated. Now, the second example that we saw for Flipzone, there is a dedicated capacity. So while it is 55% of the total warehouse, but of that 55% entirely being used by a customer, and therefore that aspect has been covered. Now let's look at the third aspect, which is the substitution. So let's look at a third example, which is a customer enters into a contract with a supplier for a period of 10 years for the right to use a vehicle. The vehicle is explicitly specified in the contract. Whether the supplier has substantive substitution rights. Let's look at two separate scenarios. One, a supplier has no substitution rights for the first 4 years from the commencement of the contract. However, after 4 years, the supplier can substitute the vehicle at any time. So if we again understand the fact pattern, if for the first 4 years, if the vehicle cannot be substituted, if the vehicle cannot be replaced, another vehicle cannot be provided, in that case, the substitution right in the contract is not substantive for the 4 years period, and which is the period of the which is the 4 year period, right? So in the first scenario, therefore, it will become a lease contract at least for the first 4 years. At the end of the fourth year, if there is a substitution right triggering, at that point in time, the evaluation may need to be done once again in that case. In scenario 2, if supplier can provide any substitute vehicles in case of availability of the vehicle or unavailability of the vehicle, in that case, the substitution right is substantive, and therefore, in those scenarios, it may not be considered as an identified asset. Okay, so let us move on to the second aspect, which is the right to control the use of the asset. So, the standard actually goes on to specify that a right to direct or control or a right to direct the use of an identified asset will differentiate a lease from a customer in a typical supply or a service contract. So in a service contract, the focus or the commercial terms may require only a service element to be used. Whereas if in a service contract or if in any contract, if a use of asset is either necessary or mandatory, implicitly or explicitly, then the right to direct the use of the contract will need to be evaluated. So the standard actually provides a detailed guidance on uh, depending on who and who takes the how and for what purposes decision relating to the use of the asset will actually define whether that arrangement can contain a lease or not. So, for example, if the customer, which has taken the asset as part of a contract, is able to specify the right to direct the use of the asset, in that case, it is more likely than not that the contract will contain a lease. In case if the supplier itself is able to define which asset to be used, in that case, the asset is not directed by the customer or by the lessee, and therefore the arrangement may not actually contain a lease. What happens in scenarios where uh, some of these right to direct the use of the contracts are already specified in the arrangement? In that case, the arrangement will need to be analyzed in further details. Okay. Now, while we are looking at the contract or commercial terms relating to the contract, there could be scenarios where the operations. So let's say that if there is a particular plant which is continued to be serviced by the service provider or the supplier, and a lot of operating decisions are continuing to be taken by the service provider itself, those decisions are ignored unless those decisions actually define how and for what purposes the decisions are predetermined. In those scenarios, the arrangement then can become again a leasing arrangement. The second category is, for example, the use of asset is while the use of asset has been predetermined, but if the supplier has what is called as a protective right, and that right is defining the scope of the customer's right to use the asset, but not in isolation, can actually exclude that from the leasing arrangement. Okay. Now, while the terms are becoming a little bit more complex, let us probably look at some of the examples to understand this in greater detail. Okay. Can I take the questions? Uh, one by one. Only the capacity. So Aziz has posed a question. Only the capacity portion will be considered as an identified asset. So if the capacity is distinct and is earmarked separately, then only it can be. So if so long as it is specified. So let us take an example where let's say a fiber optic cable has been laid down for a particular building, and a 60% of that fiber optic output is consumed. In that case, a capacity portion will not be considered, because you can't differentiate what is the capacity portion within the broadband connectivity that may be achieved from this. Or let's say if there is a power plant which has been set up, and out of that power plant, say 30%, 40%, 50% output has been considered, but you won't be able to say that the capacity of that has been consumed accordingly. So the example that I gave about a warehouse, it is both physically possible to identify, isolate. In that case, it will be considered as an identified asset. uh, so Brebar has raised a question on the previous example, where why substitution right is after 4 years. Any specific clause mentioning this? So probably it's just the example. That's the way in which the example has been created to show that if there is a substitution right available after a period of 4 years. So the substitution right, if I go back to the requirement, if the supplier has the substantive substitution rights throughout the period of contract, then it may not qualify as a lease. Whereas in this case, the right comes in only at the end of the 4th year. That is the way in which the fact pattern has been, and that's the reason why it is considered as a lease, at least for the period of 4 years, and therefore it will be considered as a substantive substitution right after 4 years. So has no substitution right for the. So if you look at the fact pattern on the left hand side, it actually says that no substitution right for the first 4 years. That's the reason. Okay. Um, I'll move on to the next part, which is the right to control the asset. So let us again go through some examples. So right to direct the use of an asset. So let us look at this example now. A customer enters into a contract for 6 years with a supplier to install an air conditioning plant in its office premises. Air conditioning plant is designed as per the specifications provided by the customer. To optimize the efficiency of the air conditioning plant, the supplier provides operations and maintenance services on a regular basis and as and when required throughout the contract period. However, the customer decides and directs the hours of operation and the floors of the building on which and at what time the cooling is required and the temperatures to be maintained by the air conditioning staff. Now, whether in this case, the customer has a right to direct the use of the air conditioning plant. So in this case, actually, based on the fact pattern, the customer is actually able to direct how and for what purposes the AC plant is getting used. Supplier's right to operate and maintain the plant, which is essentially only an operations which is carried out at the instruction from the customer, are not considered as a right to direct how and for what purposes the asset has been used, and therefore this will be considered as a right to direct the use of the asset. Okay, let us look at the example relating to predetermined decision. A customer enters into a 20-year contract with an energy supplier to install, operate, and maintain a solar plant. The customer designed the solar plant before it was constructed, so it is completely designed as per the specifications of the customer. Customer has hired experts in the solar industry to assist in determining the location of the plant and the engineering of the equipment to be used. Customer has the exclusive right to receive and the obligation to take any energy that has been produced. Okay. Now, uh, the way in which this contract is operating is that all decisions are predetermined as part of a contract, and therefore if you again go back, the analysis will be required, saying that all decisions are predetermined. Then whether a customer is able to control the asset, in that case, yeah, because all the decisions have been pre-specified as part of the contract, then the arrangement will actually contain a leasing in that scenario. Okay. Now let us look at an example where a supplier has a right, but it could be considered as a protective right and not as a substantive right. So we've already looked at an example where the rights were substantive in nature. Now, which can be considered as a protective right in nature? So customer L enters into a 2-year contract with supplier M, uh, who's the aircraft owner, for the use of an identified aircraft. The contract details the interior and exterior specifications uh, of the aircraft. The contract also contains a contractual and legal restrictions on where the aircraft can fly. Subject to these restrictions, L, who is the customer, determines where and when the aircraft will fly and which passengers or cargo will be transported using this particular aircraft. M is responsible for operating the aircraft and using its own crew. Now, because the contract actually specifies restrictions on where the aircraft can fly, actually defines the scope of right to use the aircraft. So here in this case, customer L is actually determining how and for what purposes the aircraft is getting used throughout the period of use. L actually has an unconditional right to change the decisions throughout the period of use. Now, because of these rights being available, the contractual and legal restrictions on where the aircraft can fly is essentially a protective right and do not really prevent L from having the right to direct the use of the aircraft. For example, this aircraft may not fly, say, over Israel during the war zone or to Ukraine during the war zone. Those kind of restrictions are considered more as protective rights and they are not substantive rights. And therefore, in this case, while the contract may specify restrictions on which certain zones not to be flown, those are more considered as protective rights and not exactly substantive rights. Okay. Uh, please feel free to ask questions. If any, please feel free to ask questions. Let's move on to the next part, which is the term of the lease. Now we've already understood what is an identified asset, what is the right to control the use of the asset. Now while these terms sound a little bit more complex, it is also important to understand what is the period for which the lease has been taken. Now these are very similar to what was there in the previous standards. The standard goes on to define the lease term as lease term is the non-cancelable period of lease together with optional renewal period if the lessee is reasonably certain to extend this, and periods after an optional termination date if the lessee is reasonably certain not to terminate this early. So it's not necessarily that it is only the contractual period that is taken into consideration, and we'll probably understand this a little bit further on the subsequent slides. But the optional renewable period, if the lessee is likely to extend the lease beyond the first mandatory lease period, and even after the optional termination date, if the lessee is reasonably certain not to terminate this early. So the institute has obviously come out with an implementation guide and has provided a lot of clarity around these points. But let us try and understand the nuances relating to some of the aspects. So the first part is the non-cancelable period. So while taking into consideration the lock-in period or a non-cancelable period where neither party, especially the supplier, is not able to cancel the contract. that will be considered as a non-cancelable. So while considering while taking into consideration the non-cancelable period, aspects such as notice period. So for example, if there is a contract which is for a period of, let's say, 10 years, it has a 5 years lock-in. And in that lock-in, at the end of the lock-in, you require a mandatory 1 year notice period even after the lock-in to terminate the contract. Then that 1 year period will be considered as a non-cancelable. So therefore, notice period will be taken into consideration. Also will be taken into consideration the contingent termination provisions, and which we'll talk about by means of examples in the subsequent slide. Now, in addition to the non-cancelable period, there could be an enforceable period, which is beyond the termination period, where the contract may have terms and conditions, or the local laws and regulations may actually have requirements, or there could be penalties or termination rights which can actually enforce the contract. These two aspects put together will actually define what could be the lease term. Now, the lease term is while the lease term is assessed at the inception of the contract, on an ongoing basis also the lease term will need to be evaluated. So in case if there are any significant events or changes in circumstances within the lessee's control, so for example, if the contract had a particular clause that in a building can be terminated because of force measure, or maybe aspects beyond control of the lessee now becomes within the control of the lessee, those aspects will also need to be taken into consideration for determining the lease term. Also, any changes in the non-cancelable period, that also will be considered for assessing the lease term. So if we were to understand this aspect a little better, probably I'll explain this by means of a graph. So what exactly is a lease term? So let us probably look at this portion where there is a lease is commencing on a date 0. There is a minimum lease term, which is a lock-in period. Okay, and in that the lessee doesn't have any option to terminate the lease period. There is a possibility, or there is a clause, either explicit or implicit, which allows the lease term to be extended up to a certain period, which is maximum period. Now that could be an enforceable option or may not be an enforceable option. So therefore, if you look at the 3 periods, the lease commencement date, the minimum lease term, and the maximum lease term, the period between the lease commencement date and the maximum lease term is considered as a non-cancelable period. The period between the minimum lease term and the maximum lease term is considered as a lease term only if there is a reasonably certain period is there. We will probably understand in greater details what exactly is reasonably certain period. Now, the entire period from the lease commencement date till the maximum lease term date is called as an enforceable period. Okay, so the enforcement option is possible. It could be the sole discretion of the lessee, or it could be mutually decided, or it could be sole discretion of the lessor. So that will need to be evaluated for the purpose of determining the lease term. Let us look at another example to understand this particular aspect better. A lessee enters into a contract with the lessor to lease a machinery for a non-cancelable period of 3 years, which includes a 3 years fixed renewal option. So there is an initial term of 3 years, and there is a renewal option for another 3 years. Lease payments on renewal are expected to approximate the market rate at the time of renewal, and if not renewed, there are no lease termination penalties. In addition, the machinery is actually in this particular fact pattern. The machinery is getting used for in manufacturing of components for a mobile handset that is expected to remain popular until an improved model is completed in approximately 3 years. So another 3 years that machinery is likely to be usable. Cost to install the machinery in the facility is not significant. Machinery is not expected to be used in manufacturing of any other type of handsets, and the remaining economic life of the machine is 12 years. Now, in this scenario, while the contract is actually specifying that there is a 3-year fixed term, a fixed price renewal option available at the discretion of lessee, there is no economic incentive for the lessee to exercise that option. And therefore, in this case, the lease term is considered only as 3 years because there is no compulsion for the lessee to exercise that particular option. So if there is no economic incentive, in that case, the renewal option is not considered as substantive. And therefore, the lease term will be considered as only a period of 3 years and not the extended period of 6 years. Let us look at another example where a reasonably certain criteria has been demonstrated. So entity X, who's a lessee, enters into a lease contract for a retail shop for an initial non-cancelable period of 4 years. And the contract also specifies a renewal option for further 3 years at the same rent. Entity X pays for leasehold improvements carried at the behest of the lessor. So the lessee is actually paying for the leasehold improvements. Further, at the inception, rentals are recorded at market rates, but market rentals are expected to increase by 12% over the lease period, over the lease term. Entity X is expecting to run the shop for at least 8 to 10 years. So the contract non-cancelable period is 4 years. The option is for additional 3 years. The the entire leasehold improvement is carried out at the behest of the lessee, and the lessee is expected to run the shop for at least 8 to 10 years period. The location is advantageous for a profitable business. The leasehold improvements are expected to have a significant value, and at the end of 4 years, and the value can only be realized through continued occupancy of the leased property. So in case if the lessee vacates the property, the entire leasehold, which has an estimated useful life of of 12 years, could be scrapped, and there won't be any value that is generated. These have been while these have been incurred by the lessee at the behest of lessee, and therefore it may not have any value. So if the estimated useful life was 12 years, at the end of 4 years, the entire amount could then be required to be written off to P&L. So what the lessee X is doing in this case is, at the inception, it can be considered as X is considered to be reasonably certain to exercise the renewal option because they're getting a substantial benefit from lower and potential economic. So they're getting a substantial benefit because the market rentals are comparable, but they have incurred a significant leasehold improvement expenditure, and there is a potential economic penalty for leasehold improvements. As a result, the lease term accordingly is considered as 7 years, which is basically the initial non-cancelable period of 4 years plus the renewal period of another 3 years. So 7 years is the lease term under this particular arrangement. Let me check if there are any more questions. Okay. Again, in case if you have any questions, please feel free to ask the questions. Yes, please. Raghavendra. Should I wait for the question to come in? Okay, I'll proceed. Now let's look at the last aspect from the original definition. What exactly is the consideration? So what is considered being a consideration for under the contract, under the leasing side? So lease payments essentially are defined to include 4 different elements. Fixed payments, less any lease incentive. So whatever is the fixed amount that has been specified in the contract. Variable lease payments, only those variable lease payments that are dependent on an index or a rate. We'll probably understand this in a greater detail as we go further. In case if the lease contains an exercise price of an option, to extend if the lease, or at the end of the lease, if there is a purchase option that is available, then and the lessee is reasonably certain to exercise that option, that also will be included as part of part of the lease payments. And in case if there are any penalties for determining termination, if the lease term reflects the lessee exercising an option to terminate the lease. So, for example, if the contract is for a period of 10 years, if the contract is broken before a period of 10 years, if there is any penalty that is levied, that penalty amount also will be included as part of lease payments for evaluating the total lease amount accordingly. Let us again look at the fixed versus variable payment by means of an example. Entity X enters into a 20 years contract with a power company, Entity Y, to purchase electricity produced by a new solar plant set up by Entity Y. The contract is assessed as it contains a lease. Okay, there are no minimum payments requirements and no fixed payments are required. However, Entity X is required to purchase all of the electricity produced by the solar plant at a price of INR 10 per unit. It is highly probable that the solar plant will generate at least some electricity each year. Okay, so here's a contract where the contract has no minimum payment clause, but in case if any electricity is generated, in that case, that electricity will be purchased by lessee, entity X in this case, at a price of 10 rupees per unit. In that case, while the solar plant will generate some electricity, the assumption is solar plant will generate some electricity, all payments are considered as a variable payment because there is no minimum commitment specified in the contract. And therefore, the amount of all payments vary with the amount of electricity produced, which are not dependent on any index or rate. And therefore, for the calculation of lease liability, these payments will be considered. So these are considered as completely variable payments, and they are not dependent since they are not dependent on any index or rate. Therefore, if in effect, while this is considered as a leasing arrangement, but it may not contain a right of use asset, it could be considered as a short-term lease. In that case, we'll learn about short-term leasing towards the end of this particular session. Okay, let me take up a question. We have lease. So Raghavendra has asked a question. I'll just read out the question first. We have leases from lessee point of view, and we are accounting as per Ind AS 116. And recently, company acquired one property which is exclusively for giving rental. Let's say 5 lakhs per month at 5% YOY for a 7 years period. Do we need to account for this as a lessor, SLM, or any exemption available in Ind AS 116? Also, compare Ind AS 40. Uh, we classified this asset as an investment property. Does the board standard apply or will be applied independently? So first of all, I think Ind AS 40 will be applicable in case of the investment property. If the property class qualifies as an investment property, and in case if the property is owned by the company, so the rights equivalent to the ownership are attached, then it will meet the definition of investment property, and therefore that asset will be capitalized in the books as something which is owned by the company, either owned or substantively owned by the company. The lease accounting, the lessor accounting, which we are not covering as part of today's session, but just to answer the question, will be applicable in this case because you have actually acquired a property. If you have acquired this property on the rent, then the lessor, then the and if you have acquired this property to give it on a rent, then that will be considered for lease accounting from a lessor standpoint. The investment property accounting will happen for the cost of the asset. Lessor accounting will happen from the Ind AS 116 perspective. Okay. Does it answer your question? All right, I'll move on. Okay, let's look at another example for fixed and variable payments. Entity X, which is a lessee, enters into a 20-year contract with a power company, Entity Y, to purchase electricity produced by a new solar plant set up by Entity Y. Entity X and Entity Y assess that the contract contains a lease. Entity has to make a payment of minimum 10,000 rupees to Entity Y. Further, Entity X is required to purchase all of the electricity produced by the solar plant at a price of rupees 10 per unit. Okay. In this case, the minimum payments of 10,000 are unavoidable. So any payment above rupees 10,000 will be considered as a variable payment, which are going to be vary based on electricity produced. And since it is not dependent on any index or rate, these variable payments are excluded from the computation of lease liability. So the lease liability will be computed at the minimum guaranteed payment of 10,000 only, and for the additional portion, it will be recognized as an expense as and when incurred. So while again a supplementary question from Raghavendra, that if there is no exemption even if it is not material. Now with Ind AS 1 getting amended, all accounting policies are to be applied only based on a material. So in case if the amounts are not material, you need not apply the accounting policy irrespective what is there. While fundamentals will still prevail, but materiality can be an override. And therefore, if the amounts are not material, you may not evaluate that arrangement for lease accounting, or even if you consider one way or the other, because of materiality, there could be an overriding consideration. Of course, your auditors will also need to be taken into consideration. Their views will need to be also evaluated. Okay, now let us look at the third aspect which we considered, which is the purchase option at the end of the lease. Okay, so lessee X enters into a non-cancelable 5 years lease with lessor to use a piece of equipment in an evolving area of technology sector. So it's a new age technology led company where there is a 5 years contract that has been entered into by lessee X. There is no renewal option in the contract, but X has the option to purchase the equipment at the end of the lease period for 50,000. Because this piece of equipment is used in an evolving area of technology which is subject to rapid change, and the fair value of the equipment at the end of the lease term is subject to significant volatility, where the estimate of such equipment could range from say 40%, 40,000 to 90,000. Okay. The duration of the non-cancelable period of 5 years is significant in this context. This reflects, for example, that newer and or better alternative assets may be introduced during the 5 years period. Now, in this case, the economic incentive will need to be assessed to exercise the purchase option. And because it is a rapid changing technology, the entity X may conclude that at the end of the 5th year, there may not be a renewable option available because the cost of technology may go down significantly or may go up significantly. And therefore, at the inception of the lease, the lessee may conclude that it is not reasonably certain to do so in that sense. All right. Now let's understand the last aspect in payments, which is payments which are linked with index or rate. Again, let's go through this example. An entity enters into a 10-year lease of property. The lease payment for the first year is INR 10,000. The lease payments are linked to the consumer price index. That is not a floating interest rate, but a CPI index or consumer price index. The CPI at the beginning of the first year is 100, which is remaining unchanged. The lease payments are updated at the end of every second year, At the end of the year one, CPI is 105. At the end of the year two, CPI is 108. Okay. Uh, at the inception of the lease, the potential future changes are not considered. So you will not consider 105 or 108 at the inception of the lease. It will be completely excluded from. It will be completely ignored. At the end of the year one, the payments have not undergone a change. Okay, in this fact pattern, and therefore the liability is not updated. Sorry, I think there is a typo here. In this example, it should be 100 and not 105. It should be 100, where the CPI has not moved at all, and therefore it should be considered as 100. At the end of year two, when payments are undergoing a change, the remaining payments are updated, but it will be discounted using the same discount rate. We'll look at how exactly discount rate will work in the subsequent section of this. So clear, the payments which are linked with index will be updated not at the inception, but as and when the actual index or rate is changing at that point in time, and it will be considered as a prospective change. Okay. So that actually completes the definition of lease. So we have actually evaluated each of these aspects, which is what is an identified asset, what exactly means by being able to having the right to control the asset, what is the term that need to be considered, and what exactly will be included as part of a consideration, whether it is a fixed consideration or a variable consideration. Now let us look at some of the other aspects that are also important in understanding the requirements of Ind AS 116. Let us look at discount rate. So again, I'm probably restricting myself to only a lessee accounting. For lessor, the determination of discount rate has slightly different requirements. But for lessee, the standard requires that the lessee should discount the lease payment using a discount rate, which is determined using either rate implicit in the lease, if that is readily available, or incremental borrowing. So what is meant by rate implicit in the lease? So essentially, it is the rate that will measure the minimum return that the lessor is expecting to earn from the lease. And now this becomes very subjective, very complicated, very difficult to determine what is the kind of rates that the lessor will, because the lessee may not have the perspective on what are the rates expected from the lessor. And therefore, the standard has also provided an alternative view, saying that you can actually use an incremental borrowing rate, which is essentially the rate that the lessee would expect to at uh, um, borrow at over similar term and very similar security on the right of use asset. So, for example, if the underlying asset is, let's say, a building or plant and machinery, for that kind of asset, for that similar tenor, what could be an incremental borrowing rate from the perspective of the borrower is actually taken into consideration for determining the incremental borrowing. Since determination of discount is fairly clear now, rate implicit in the contract is not normally used. In most cases, companies are obtaining rates from the banker. Typically would provide for our underlying asset, it is vehicles, property, plant, property, or any other asset. You would typically go to a bank and request them to provide for a similar tenor, for a similar group of asset, what will be the discount rate. And therefore, in most scenarios, an incremental borrowing rate is used and not necessarily the rate implicit in the lease, unless it is very ready. Let's move to probably the towards the end sections of this. A lease contract may actually contain both a lease element as well as a non-lease element. So there could be let's say there is a rental contract which also has maintenance services being provided as part of the leasing arrangements. It may include explicitly or implicitly. It may be a composite contract. It could be a separate contract. So what does the standard require us to do? A contract may contain both a lease and a non-lease component, such as payment for services, which is required to be separated in the standard. Uh, the standard also provides a practical expedient not to separate the two and account for them as a single component. So how exactly do you go about identifying the component? So for determining the component, ROU is considered as a separate asset if it actually meets the following criteria. Lessee can benefit from using the underlying asset either on its own or together with other resources that are readily available. And asset is neither highly dependent on or highly interrelated with other assets in the contract. In those scenarios, those components are identified separately. Charges for administrative tasks and other costs incurred associated with the lease that do not transfer goods and services to lessee do not give rise to a separate component. However, they are actually part of the total consideration that the lessee allocates to the identified component. The standard then goes on to specify the step 2 to account for the component. So we've identified the component in step 1. Now we are accounting for the components in step 2. Allocate the consideration in the contract to identify components based on relative standalone fair value of the the component and the aggregate of the non-lease component. So for example, if you're entering into a contract for an integrated contract for rent in a building as well as monthly maintenance charges, then that will need to be segregated unless you're actually using the practical experience. So determining the relative standalone price of lease and the non-lease component based on the price that the lessor would charge a company for the similar component separability. So that is how the standard requires you to separate the lease and non-lease. If an observable standalone price is not readily available, then estimate the standalone price of component by maximizing the use of observable. So as you would probably know, Index 103, Index 109 and Index 113 have guidance on fair value, and that's where an observable standalone price is not available. Then you would actually determine based on an estimate standalone price of components uh, by maximizing the use of observable information. So let's look at an example for non-lease component. Lessee B enters into a 5 years lease of a photocopier. The lease payments are 10,000 rupees per annum. The contract includes an additional maintenance cost of 500 rupees per annum. B considers the contractual payments and separates the service component of the contract, that is maintenance contract, as a non-lease component. B notes that based on the observable prices, the lease and non-lease components are priced at a standalone prices. Now, as an annual lease payments are fixed uh, as a fixed amount, the present value of 5 annual payments is included in the initial measurement of lease value. Maintenance costs will actually be excluded from the computation of lease liability in this particular case. While 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 the standard requires you to separate the lease and non-lease components, in practice it could be very difficult to determine what exactly is the fair value or relative fair value of the non-lease component as well. And therefore the standard actually allows an option to continue to use a practical expedient, and the practical expedient then allows to combine the lease and non-lease components. So for example, if you entered into a real estate a contract to rent an office premises, let's say at 100 rupees per square feet, and you also pay say at 20 rupees per square feet as a non-lease component, and you want to use the practical expedient and not separate that 150, and therefore for the purpose of computing your right of use asset, 120 rupees per square foot would be considered as a practical expedient and need not be separated based on fair value, right? If if the lease applies to the practical expedient to treat multiple leases and non-lease component as a single contract, the nature of the individual components, that is whether they are fixed or variable, depending on the index, that will not undergo a change. The last part that we'll talk about is modification in the lease contract. So a lease modification can happen because of the change in the scope of a contract. A lease modification is considered as a change in the scope of the contract or considered uh, 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 for a lease that was not part of the original terms and conditions. So what may happen as part of a lease modification? Increasing the scope of lease by adding the right to use one or more of underlying assets, decreasing the scope, increasing the scope of lease by extending the contractual lease term. So you may add a portion, you may delete a portion, you may change the amount, you may increase or decrease the term or contractual term, and you're changing the consideration in the lease by increasing or decreasing the lease payment. Each of these aspects could be considered as an example for leasehold modification. So changes that result from renegotiations of the original lease contract are lease modifications. Adjusting the lease payments, cash flows by contractual rent adjustments, mechanics, and reassessing whether the lessee is reasonably certain to exercise or not exercise an option included in the original contract. So in case if there are any clauses that provide in the existing contract any modification of terms, those are not considered as a modification for the purpose of this. Let us try and understand this a little better by means of this particular chart. So in case if there is any change in the contract for a lease, if the changes in the carrying amount of lease liability is due to factors such as reassessment of a lease term, changes to purchase option, residual guarantee amount. In those cases, in case if these changes are prospective or relate to future period, in that case, the ROU asset is actually re-recognized. So the amounts are of ROU assets are then recomputed in that. Um, if the variable lease payments are dependent on index or rate that are now becoming in substance a fixed payment when the variability is resolved. So, for example, there was a particular condition that was specified in the contract, which was actually linked with index or rate, and now that particular index or rate. So, for example, depending on say a Sensex or based on a rate, based on inflation index, etc., and that particular criteria has been now been met, the classification between whether you change the ROU asset or whether you recognize difference in P&L will actually depend on whether these reassessments of terms are relating to past period or current period or future period. In case if it is relating to future period, then it goes on to change the right of use asset. In case if it is related to a current period, then the differential amount will be charged in profit and loss account. So the variable lease payments that are not dependent on an index or a rate will always be recognized as an expense to profit and loss. So let us again understand this with a little bit more detail. So let's say that there is a change in the scope of a particular contract. Okay, so what are the terms conditions that are undergoing a change? There is an increase of in the scope of lease, adding ROU for one or more underlying contracts. So you had an office space on the rent, and you added additional space in that. If that change is at a standalone price which is comparable with market, then in that case it is considered as a separate lease. For that separate lease, the way in which the accounting will be done is because it is considered as a new lease. At the inception of the lease, you will need to determine the applicable discount rate, and that discount rate then will be used to compute the new lease contract. If that lease is not at a standalone price, then in that case, the lease liability is actually remeasured and the ROU asset is accordingly adjusted. So that is the case for all other ROU modifications as well, right? In case if there is any decrease in the scope, the lease liability is actually remeasured and it is again adjusted in ROU, and the resultant gain loss or partial termination is actually recognized in P, right? So in this part of the section, the uh, the uh, the lease is not restate. The discount rate that is used is not changed. The original discount rate itself is actually considered as applicable. Okay, I'll take up some questions that have been posed before we move further. So Bharat Jakotia has asked that, can you please help in understanding how has Ind AS 116 accounting of leases providing depreciation and interest brought comparability in reporting across industries against showing an interest expenses in period? Okay, let me give an example from, let's say, an airline industry. Again, this was the example which was actually used by ISB for advocating the revised rent model. Let's say that there are two separate airline companies. Let's say Indigo Airlines and SpiceJet. Now, the airline leases are fairly complex arrangements, but let's look at a very simplified example that one lease, and there are wet leases, dry leases, with fit out, without fit out, those different kind of leases. Okay. Now, let us take two examples. Both of the companies have leased the aircraft. Um, One has considered the estimated useful life as 10 years, and the lease contract is for a period of 10 years. Therefore, it is treated as a finance lease because it is covering significant portion of the economic useful life. And therefore, that lease is treated as a finance lease, recognize that on the balance sheet. Okay. The other company has considered the estimated useful life as 12 years, for example, and the lease term is period of 8 years, and therefore it is considered as an operating lease. Now, when you are comparing the performance of these two airline companies, let us for a minute assume that it is same Boeing 737 which has been leased. One will be treated as a finance lease, therefore capitalized, then charging depreciation, and therefore the interest expense, the current accounting, the way in which the ROU accounting happens, that's how the accounting will happen. In second scenario, the entire amount is treated as an expense on a straight line basis. Now, if there are different varying terms conditions for financing arrangement, if the payment terms are varying, straight lining impact would be different, and therefore the balance sheet of both these companies are not at all comparable. So, for example, the first company which has treated this to be a finance lease, it is seen as a heavily leveraged company because it has an asset on the balance sheet, but it also has debt on the balance sheet. The second company, which is recognizing the entire lease expense to P&L, its balance sheet is quite healthy, but profitability could be significantly lower. Its EBITDA could be lower because the expense is recognized above EBITDA. That's a very good example. That's an ideal example to show that how exactly the depreciation and interest accounting will affect this. Now, if both these companies, now I gave an example where the estimated useful life was different, but even if the estimated useful life was same, the accounting treatment in both these companies would have varied significantly. Now, under the leasing model, since there is only a single lease accounting model, both the leases will come on the balance sheet. Therefore, both the assets and liabilities, as well as P&L expenses, which is below depreciation and interest expense, will be considered as comparable in this particular. Moving to the next example, one client's company has taken, so Akshay Shah has asked this question. One client's company has taken building on lease, and now company is allowing one of its company to use premises to register office in ROC by giving ROC and without consideration. So in this scenario, sublease clause is applicable, and if yes, how it is calculated. Now, this is a little tricky because this is effectively could be a related party transaction because a sublease without consideration has been incurred, and therefore it may not the lease accounting for sublease may not trigger in this case primarily because there is a free of cost lease that has been, but the there will be lot more additional factors that will need to be evaluated. But based on the limited fact pattern that you provided for, it may not trigger lease accounting as a lessor because there is no recharge that is happening in the books. There won't be a notional rent added and then notional ROU created for sublease accounting. Okay, let's move on further. Let's look at a lease modification example. So we've actually seen that how exactly the lease modification will operate, whether it is considered as a standalone price, not standalone price, whether it is relating to a current period or whether it is relating to decrease in scope. Depending on that, it will be treated as a separate lease or it will be treated as not separate lease, and accordingly, the lease liability will be remeasured. ROU asset could be adjusted or it could get recognized as a separate new asset. Now let's look at an example. Uh, Lessee Z enters into a lease contract with lessor L to lease and a floor in the office building for a period of 10 years. Z's business expanded, requiring an additional office space. At the beginning of the year 7, which is probably in a 10-year contract at the beginning of the year 7, Z and L have amended the contract to grant Z right to use additional floor space of the office space in the same building for the remaining 4-year period. The new office space is of the same size as the original office space and is similar in all significant aspects. The lease payments for the new office space are commensurate with the market rents for the office space of that size and characteristics. However, Z receives a 5% discount in the new office rentals because its existing relationship with L has enabled L to forego costs that it could have incurred if additional floor had been leased to a new tenant. For example, if this was to be leased out to another independent party, then L would have incurred marketing cost, agent's commission, cost of undertaking, credit check, etc. So that 5% represents that portion. So this in this particular case, a modification is considered as a separate lease because the scope of lease has been increased with an additional space. Additional discount that has been provided, 5%, is actually not a separate discount, but it is effectively a compensation for the cost that are incurred, that is marketing costs, etc. And therefore, Z will treat this as a completely new lease and will not treat this as a modification of an existing lease. In case if so Raghavendra has asked a question that if the same lease is getting renewed, then a separate lease asset and liability to be created. So if the lease is getting renewed, so so let's look at 3 different scenarios. So let's say that there was a lease contract that was entered into for a period of 5 years. There was no renewal option in that. And now that contract has expired, you entered into a new contract. So the original contract was the lease term was considered as 5 years. If the contract is renewed, then it will be treated as a new lease. Let us look at a second scenario where if the contract had a renewal term, but because of the additional factors that we had considered earlier, whether those factors are substantive, not substantive, for determining the lease term, if these criterias were not met, and therefore it was considered reasonably not certain period, in that case the lease was accounted for only as the initial term of 5 years, then also it will be considered as a new lease. If in the original contract either there was some compulsion, some economic compulsion, and therefore the lease term itself was considered as a longer period, in that case, the first lease itself will be for a period of 10 years, and therefore the it will not be a new lease at the end of 5 years. Also, the original lease itself or original ROU asset itself will be considered as continuing. All right. So what exactly the lease accounting, how exactly the lease is accounted for? So effectively, you will first compute a lease liability. How is lease liability computed? You will basically take into consideration, excuse me, you will take into consideration all the lease payment that are specified in the contract. So fixed payments, variable payments to the extent they are linked to an index or a rate, those payments will be plotted. You will determine either discount rate which is implicit in the lease, or you will take into consideration incremental borrowing rate, and then you will consider these additional factors that we looked at for lease payments. If there is any exercise price or purchase option, if there are any penalties, termination, on termination, etc., those lease payments will then be discounted at the discount rate that has been determined in accordance with this section. That amount will be computed as the lease liability. And that lease liability is recorded at effectively discounted at over the lease term, and therefore it is recorded at a present value. To that determined liability, the additions that will happen will be any initial direct cost, so any brokerage, any commission, etc., that has been paid at the inception of the lease, that will be added as the initial direct cost. In case if there are, let's say, if it's a property and you've done interior fit out, etc., the estimated cost dismantle, remove, restore, that will be computed in accordance with Ind AS 37. That will be added. If there are advance payments that have happened, if there are prepaid lease payments that have happened, because the way in which you're doing the lease accounting is for effectively recording the amount payable like a equivalent to a loan. So against, in addition to that loan, if there are any advance payments or deposits that are considered, those will be added to this, minus lease incentives, if any, if there are any amounts that are receivable as a deduction from lease, those will be considered. And that summation will be actually giving you the right of use asset. Since we've already all the companies have actually adopted Ind AS when it became applicable a couple of years back, I'm not covering the initial exemptions that are available on initial recognition or first time adoption. And so first time adoption had given a couple of options. In case if you are a company which is adopting Ind AS now, on a first time adoption, there are two basically options. Either you can go full retrospective and restate all the lease arrangements that exist on the balance sheet date with retrospective effect. You can actually do partial retrospective. You can do prospective, and there are a couple of options available, but I have not covered them as part of this particular session. Let me take up the next question. Is commission, so Raghavendra has asked another question. Is commission consultation charges paid to an agent considered as a lease rental to discount? No, it is not. It is treated as, I just now mentioned that part, that it is considered as part of an initial direct cost. So it will not be included in the rent amount, but it will be added to an initial direct cost to compute the leasehold, to compute the right of use. Will the refundable security deposit be added to a lease liability? So typically, the refundable security deposit is not added to the liability, but typically what will happen is because the deposit refundable is considered as a financial asset, you would record that at present value. So let's say that you've taken a premises on lease, and for which you've given a security deposit. The security deposit is interest free and is repayable after a period of 5 years. Therefore, you would typically record the security deposit at present value. So when you're recording the security deposit at present value, the difference between the carrying value of the security deposit and the present value, that amount is actually added to the right of use asset. Okay. Continuing this, so we briefly touched upon this at the beginning itself. So basically, as I mentioned in the example that I gave on the airline company, the lease accounting has definitely resulted into a significant impact on the balance sheet. Companies that had significant operating leases have more assets coming on the balance sheet. So, for example, if there are retail companies which have taken, say, warehouses on rent, which have taken which have franchisee arrangements, or which have company owned shops which are taken on lease, etc. Those arrangements are now coming on the balance sheet, and that is actually resulting into an impact on both balance sheet as well as on P&L. So the impact that is there on uh, uh, so the EBITDA, because the lease is getting recognized on the balance sheet, and the resultant impact on P&L is getting recorded as an amortization of right of use asset and interest expense. Therefore, the EBITDA is looking healthier. EBITDA is improved, so EBITDA goes up. Balance sheet is getting grossed up, so therefore total assets are increased. And at the initial recognition, the balance sheet will be grossed up, and therefore the balance sheet will look much bigger. Now, the way in which the asset and liability is recognized in the balance sheet, they also don't go on exactly in the same manner. The right of use asset is amortized on a straight line basis, and therefore will decline on a steady state basis. Whereas the financial liability that is recognized depending on the payment terms of the financial liability will typically be similar to the right of use asset at the inception, but will actually decrease slower as compared to right of use asset. And therefore, the balance sheet gearing ratios will actually be affected to a large extent. So if you see on the graph on the right hand side, at the initial stage, maybe the asset and liability could be equal, which is also an option that is given on the initial adoption, that you can recognize the right of use asset equal to the liability. But the asset will depreciate faster, liability may decrease slower, and therefore your balance sheet may to that extent be affected to that extent. On coming to P&L, we've already mentioned about the improvement in EBITDA. The lease expense in the initial period, because it includes interest expense, which will be higher in the initial period, right of use asset, which is constant. But since the interest expense is higher in the initial period, you will see here that in the initial year, the P&L charge is higher. The impact on P&L is higher in the initial period, and it goes down in subsequent period. There are two specific exemptions that are provided because the entire exercise that is required for recognition of right of use assets, financial liabilities, a fairly elaborate one, involves identifying the lease amounts, the lease payments, discount rate, etc., to bring in some practical relaxation. The standard itself has provided two exemptions. One, which is relating to short-term leases. So any leases for a term of 12 months or less, uh, the companies need not do the entire exercise. They can actually recognize the lease rental to P&L directly for those short-term leases. The second exception is low value. So while the standard does not specify what is meant by low value, a company will need to uh, adopt for work value threshold. When the standard was introduced under IFRS, there was some discussion about having a threshold of about $5,000 as a threshold. Under Indian GAAP, if you remember, under the erstwhile Schedule 6, there was this clause about 5,000 rupees or less assets were charged off to P&L. But different companies have taken different thresholds. In a lot of companies, laptops taken on lease, which are costing even 1 lakh rupees, uh, uh, also are actually treated as a low value assets because the global policies are in that particular. So both these exemptions will allow, it is basically a lease by lease basis. So you may have a different policy for, say, for example, laptops. You may have different policies for printers. You may have different policies for office equipment, maybe etc. It is a lease by lease choice on how low value assets exemption can be. That will result into assets liabilities not getting recognized on the balance sheet. The lease expense is getting recognized on straight line or any other systematic basis, and these exemptions can be assets which are not dependent on each other or not highly interrelated with the assets. There are some bases of, as I mentioned, there are some bases of conclusion which actually say that a $5,000 amount is indicated, but both the ITFGs provided by institute, implementation guide provided by the institute does not provide any monetary thresholds. It could be a matter of judgment where this can be applied accordingly. That actually concludes my presentation. In case if you have any specific questions, we're actually done almost 20 minutes ahead of time. In case if you have any questions, happy to take up more questions. I'll share the presentation with the council, and they can actually have the presentation. So practically, can you explain the discount rate? So let's take an example. So let's say that you've taken an office premises on lease, and let's say it's a brand new building. The estimated useful life of that building is 20 years. I'm basically oversimplifying the example, and you entered into a contract for, let's take two scenarios, an initial term of 5 years with a renewal option for another 5 years, which is considered as substantive, and only 5 years. So what you will do is, in both the scenarios, if you know that at what rate typically an office building of that type, the lessor, the builder, what is the discount, what is the interest rate that he will expect on that premises. If that rate is readily available from the builder, then you would typically take that rate as the discount, which is what we saw as the rate implicit in the lease. Okay. Now, which is very difficult because it will depend on the credit rating of that customer, his existing borrowing, his past repayment record, etc., etc. Therefore, the standard also provides an alternative option that you take an incremental borrowing rate, which reflects maybe a similar risk. So what typically could be a term loan borrowing for maybe a real estate or a building for a period of 5 years or 10 years, as the case may be. You would actually go and approach the bank, ask the bank to provide that in case if there is any premises to be built or term loan to be taken for a premises, what could be uh, the, the borrowing rate. You take that incremental borrowing rate and use that as a discount. Okay, the standard actually provides that as an option to take the implicit borrowing rate itself. So this to take the incremental borrowing rate as the discounting rate, which is what I specified just now. In addition to this, there are three specific aspects which I have not covered as part of the presentation. I have not covered a lessor accounting, but there is no significant change in the lessor accounting. The operating finance lease model still remains on the lessor accounting. I have not covered in detail the the first time adoption related requirements. Primarily, as I mentioned, that there are two options available, either full retrospective application, or there are two options available, 2A and 2B, on prospective application, uh, where you either adopt it. So I have not covered that because in majority cases the transitions have happened. And the third part which I have not covered is the presentation disclosure requirements under the standard. They're fairly straightforward requirements. If required, I'll probably add them to the slide before I'm circulating. There are a couple of more questions. If the lease agreement contains lease amount inclusive of maintenance charges, what is to be done in that case? Do we need to bifurcate the rental amount and maintenance amount? So the standard, we actually covered that as part of the presentation. That if there are non-lease payments, so for example, for a premises rental particularly, there could be an amount which is provided, which is an integrated rate, but there is a uh, clear bifurcation available for both the leasing component, the rental component, and AMC charges or monthly maintenance charges. If that bifurcation is available, there is a policy choice available. You can actually separate the lease and non-lease component. Non-lease component then gets recognized in accordance with the applicable standard, will be recognized as an expense in the period in which that those are incurred, and only the lease payments will be included in computation of the right of use assets. There is a practical expedient available in case, and the bifurcation of the lease and non-lease components is done on the basis of fair value, so relative fair values attributable to each component. If that is not to be done, there is a practical expedient available wherein you can actually gross up the amount. You don't need to bifurcate the rental amount and the maintenance amount. The total amount, you can actually create the ROU asset itself, and that policy exemption is available. Next question, the borrowing rate to be matched with the lease term and the credit profile. We actually spoke about that. The incremental borrowing rate it is basically uh, essentially the rate that the lessee would expect to borrow over a similar term with a similar security on the right of use. So for a similar security, what would be the borrowing term? Yes, your credit rating will also get impacted. Credit profile will also be impacting on this in this particular case. If any company has taken a land from government for a very long period, but the payment is not a material amount, then can we claim the exemption? So this typically happens in the state industrial development corporations, like for example in Maharashtra, MIDC leases, where there could be multiple models. One, you actually end up paying some upfront deposit and then pay a nominal amount as a lease rental. So there is only a deposit, and let's say maybe a 99 rupees or a 1,000 rupees as a nominal amount being paid. That would certainly qualify for a low value item exemption. But you will also take into consideration. So, for example, if the deposit that has been given is significant or is actually representing the fair market value, in that case, you would take into consideration the present value of that deposit, the difference between the present value of that deposit and the fair value. That would be taken into consideration for determination of ROU. If those amounts are paid in advance, then in that case, anyway, lease liability will not be recognized, but you could still end up recognizing. But yes, low value exemption can be possible in case those amounts are mostly in that case. We still have good 15 minutes, so happy to take up any questions. Yes, I mentioned that I'll add the disclosures in the presentation and well, when I'm sharing this with WIMC.
Hello, everyone. I feel all, there are a few queries coming up.
Okay, I'll just take this up. If a company takes a land on lease for 30 years, which can be further extended for around 30 years, the authority giving the land on lease determines that the annual lease payment scheduled for the year 1 to 5 years. Okay. At the end of the fifth year, it determines the annual lease payment schedule for 6 to 10. How will the lease liability and right of use will be calculated? So if the lease amount is not determined at all for the future period, then the lease term also will not be considered as 30 years, although contractually that's the case. Because if you see the requirements of the standard, it basically takes into consideration only the fixed payments. So in this case, you would not consider the payments beyond a period of 5 years, because if the payments are linked with, let's say, a market or a particular condition situation at the end of that fifth year, then in this case you would typically consider the lease term to be 5 years and then recognize the right of use asset only for a period of 5 years. Although I'm not 100% sure how this will happen, I'll probably reconfirm this once again. But at least in my view, the lease term itself will be considered as 5 years, because the payments for the balance period are not determinable at this stage. So there is no specific guidance on related party transactions. The standard as such does not really require notional accounting to be done. But if you broadly apply the Ind AS principles, let us say that there is a parent company and a subsidiary, and either the parent or a subsidiary has given uh, an asset on lease where for which no rentals are being charged. You would first apply the generic principles of Ind AS, maybe use the guidance under Ind AS 115 to determine a barter transaction or a transaction which is below market value, and there you would typically determine uh, uh, the fair value of the transaction. If the consideration is not getting exchanged, in that case it will be treated like an equity and a contribution transaction. So first of all, so let us say that the rent for a particular premises is, let's say, 1 lakh rupees per annum, and that is not getting charged. Then the first transaction is to determine from the perspective of, let's say, a parent is giving a land or premises to subsidiary free of cost. That means parent is earning income, notional income, and that amount is being benefit being given to a subsidiary. Therefore, that benefit, so it will be the accounting entry typically would be lease rental amount, income, credit, and debit will be investment in subsidiary. And in the subsidiary, the amount could be lease rate expenses, lease rent expense, debit to a contribution from parent. That's how the amount will be determined. And then for depending on the terms, conditions, for the lease term, etc., you would then compute the ROU asset. Now, the practical challenge in this scenario will be that if the lease term is not explicit, then it will be a challenge in computing the ROU asset or ROU liability. If there is no contract at all, and if everything is implicit, then it could be subjective, a very subjective interpretation. So if considerations are not involved, the arrangements then become complex and depends on interpretations, application of interpretation in that particular scenario. Next question from Harish. What about 99 years lease of land from government where initial period premium is very high and lease rental is minimum? I think I covered that uh, where there is a deposit being given, upfront deposit being given. Again, depends on the deposit is refundable, non-refundable. If it's a non-refundable deposit, then it is treated as a prepaid rental, and for that ROU asset will be recognized. So practically speaking, there could be a policy choice to treat that. It will be treated as an advance payment, so there won't be a financial liability recognized, and the amount will be considered as right of use asset without any financial liability, or the rental amount being minimal or negligible could also be considered for computation of ROU asset and liability. Last couple of questions. We have a lease where it is entered for 11 months but will be extended at the end of every month. Every year, you mean, for a continuing for a period of 5 years. Is this exempted? So basically, there is a fairly detailed guidance provided in the implementation guide that has been published by ICI in this case. So you will need to take into consideration the surrounding facts. So in fact, if I also covered some of the aspects in my presentation where for determining whether the rights are substantive or not. So the uh, uh, in this case, a lot of additional aspects that will be considered. Say, for example, whether you've done an interior fit out, what is the useful life? So I'll probably present once again my screen and show that one example which I had covered uh, already. The surrounding circumstances will need to be considered on whether it's likely to be uh, yeah, this is the example which I had covered. The example 8 that uh, at the end of the period, the substantive right, the economic penalty will be considered for determining uh, whether you will. So, for example, if you've incurred a significant amount of uh, 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 interior fit out related expenses, and the useful life of that interior fit out is longer than the lease term, then although the contract is, if the contract has a renewal option, then you will take into consideration the reasonable to certain criterion and then consider the lease term based on that particular. If company X has purchased land for a factory from various land owners for an amount of 100 crores and immediately made a lease agreement for 99 years with MIDC by making deposit of 30 lakhs, which amount should be considered as an ROS? Sorry, I'm not clear on the fact pattern, because if you purchase the land, then obviously it will be considered as property, plant and equipment. And if you're taking the agreement for the IDC for 99 years for making a deposit, uh, there can't be two same transactions. It could be, I think, something probably not clear from a fact pattern perspective. You can please uh, explain your question. Uh, Navnath has asked that question. Because they are two, if unless they are two separate leases, so separate transactions, then one will be considered as a property, plant and equipment, and then the second one is MIDC transaction, where there's a payment of deposit of 30 lakhs, which I explained already how that will be treated. Last question. In case where the lessee gives interest-free refundable security deposit, whether Ind AS adjustment is required to be done in the books of lessee, such as discounting the deposit and then recording interest income every year. So basically, there are two separate transactions. The deposit transaction is governed under Ind AS 109, and if it is a refundable deposit, interest-free, you would need to record that deposit initially at fair value, and therefore that discounting will need to be done. So let's say that you've received a deposit or paid a deposit of 100 rupees. You will record the deposit initially at fair value, let's say 70. That 30 difference, you have two options. One, you can add this 30 to ROU asset, or in other, while the standard is not very clear. So in a lot of cases, this 30 is treated as a prepayment and amortized on the systematic basis over the same period. And on 70, then you will recognize interest income every year. So irrespective whether you are recognizing that 30 as part of ROU asset or as a prepayment, the deposit which is recorded at fair value, you would record interest at market value on that particular deposit. All right, we're just on time. Thank you very much for being patient, and thank you for all the questions.
Thank you, everyone. This is Salvi Sakaria. First of all, I would like to thank our faculty for the day, Mr. Shashi, for such detailed and practical insights on Ind AS 116. Knowing that Ind AS 116 is such a vast and wide and detailed topic, it is very difficult to sum it up in the short time span of 2 hours. But I would really like to appreciate that how the major concerns were addressed and explained well. Thank you so much, sir. Further, I would like to thank Mr. Chandan Lahuti for coordinating such insightful sessions. C.A. Chintan Patel, our chairman for AS and Ind AS committee. His experience and interest on the subject matter always enhances the quality of training sessions. On this note, I would like to conclude and extend my special thanks to Mr. Gautam, Secretary of the LOIRC, and our torchbearer, Mr. Ankit Rathi, for understanding the need of the hour and organizing the training session, which will directly impact the career path of the fraternity colleagues. Thank you. Thank you so much.